broke down a lot of this year's deal activity in my opening remarks, and I gotta admit, I was naive earlier this year when the $300 million Boston Beer Dogfish merger went down. I thought that would be the biggest deal of the year. And then New Belgium bicycles up and is like, hold my fat tire. We're hooking up with Kieran Lyon, Little World Beverages. And that deal has been pegged at around 350 to 400 million. And now we got Ballast Point and a lot of questions about how much that deal is worth. So, of course, there's more rumors. There's a lot of smoke out there. We're going to probably talk a little bit about that with our next guest. Nicole Nugent Fry is here. She's the managing director of Cascadia Capital's Food, Beverage, and Agribusiness Group. I'm going to welcome her to the stage. She's going to show you a slide deck that has probably changed 52 times in the last month. So, Nicole, come on up. Thank you.
I want to thank Justin for doing my presentation. We're done. No, so appreciate it. The official cutoff for the presentation, I think, was Monday, so there are a couple high-profile deals that have been announced since that we can talk about, but they're not in this presentation, but I think timely, and I'll make sure we have enough room for Q&A at the end to discuss them. In this presentation, I'm going to go through just sort of the state of M&A, what's happened over the last few years, and how different it is today in terms of the sellers, the buyers, and the valuations. So before I do that, I'd be remiss if I didn't do a brief commercial on Cascadia. We've done several transactions in the craft beer and cider space, which are highlighted here. And we also cover broadly wine, spirits, and non-alcohol, which, as you all know, is becoming increasingly more relevant in our discussions with buyers and investors, and also the clients we represent that are thinking of expanding into kombuchas and other categories, and how that may impact their ability to raise capital or sell the business in the future. In this chart, we looked at the M&A environment, and this is deal count, not dollars, which skews the data too much. So if you look at the data since 2014, you really see the peak of the market in that 2015 to 17 period. And we think it's important to look holistically at beverage alcohol, not just beer. So you can see the peak of the market coincided with the peak of growth of the category. And that's true for wine as well, and spirits to a lesser extent, which has seen continued growth. So you see the peak of activity there, 16, 17, fell off pretty dramatically in 18, but still, a healthy number of transactions, although the makeup of those transactions was quite different. And then year to date, fallen again, but it's holding steady. And if I, updated this through today, it would be about flat with last year. So I think that's, a hopeful sign that money is still coming into the space. Albeit there's more distressed transactions and definitely more structured sales, and I can get into what that means in a little bit. You've also seen, interestingly enough, wine transaction activity fall off quite a bit. The wine volumes are essentially flat, although dollars are growing. And the Gallo Constellation deal has put a lot of activity on hold until that clears regulatory hurdles. This is all information you all know, but it's important to set the stage for what is going on in the M&A market. As you will see, the growth is driven largely by the smaller brewers. You look at 21% growth by the microbreweries, and the 51 to 7,000 plus is driving the majority of growth in the category. And so, you had double-digit growth going in favor of single-digit. Many people focused on low and no alc. Consolidating SKUs at the distributor level. And you're also seeing the portfolios of the larger brewers have acquired many attractive crafts, outperforming many smaller regional brewers. And everything's going local. And so it's very tough for many brewers to get mind share in the wholesale channel. The reason that's important is, why does somebody buy a brewery? They buy it for growth, they buy it for returns, or a geographical or portfolio fit. And so when those things don't add up anymore, the transaction activity becomes very different. And so that's clearly what we've seen in the last couple of years. There's a lot on this page, but I sort of break it down into a few groups. The top group are the largest strategics. They were clearly the most active in the peak period, ABI and MillerCoors being the most active. Constellation with their purchase of Ballast Point, and we'll talk about what happened with that later. And then the international strategics you saw do a handful of the larger brewers. They were also more flexible on structure. So the investments into Brooklyn, Founders, and Lagunitas initially were all minority transaction structures. So those were very reputable breweries where the owners were able to maintain control, still take some liquidity off the table, and still the perception to the consumer of going into relatively more friendly hands. Interestingly enough, that box below there, which is the larger craft players, is blank. They did not do any transactions during this period. It's not that they weren't looking. They were just focused on their own portfolios, where they were starting to lose share of their flagships. And they weren't competitive on valuation in many situations that we were involved with. They wrapping their arms around 15 to 20 times EBITDA multiples when they didn't quite have the synergies of an ABI or MillerCoors. They just weren't effectively competing. So they were largely on the sidelines during that period. And then you have private equity and family office. That was a very robust and active group in an industry in the consumer space growing at high teen double digits was very attractive to a lot of equity funds. Craft brewers also throw off cash flow much quicker than some other beverage categories. So it was a very robust environment. And I don't even think this is representative of how robust it was with private equity and family offices, because a lot of them were losing out in auctions to some of the strategics. So there was a very frothy environment which pushed all the valuations up. On the right side of the page, you have buyer rationale. And that's what were buyers focused on when they were evaluating breweries during the peak. Strong growth in home market, which is still true today, but people looked at that primarily as health of the brand and execution. Ability of the brand to travel. They liked to see that you had opened other states and were performing in those states. Did it fit a geographic hole in that buyer's portfolio? Particularly important with the top three was distributor alignment, because that's where they were getting their synergies. If you had a complicated network with a mix of ABI, MillerCoors, and Gold distributor networks, that they had to go in and unwind and potentially pay a lot to do that. That precluded a lot of transactions from happening, although that was less important, obviously, with the buyers on the lower part of that page. And excess capacity, that would be something we would highlight in marketing materials. Was they, currently have, 100,000 barrels of capacity, but we could get it up to 250 with very little investment, because buyers were looking at this and seeing that, this growth wave was going to continue. So that was actually a selling point back in that time in the market, and today it's very different. And then greater proportion of wholesale versus taproom. Back then, people wanted to see that you had a strong wholesale business because they felt they could grow that exponentially with relatively little investment, and that your taproom sales were actually inhibited by those four walls and how much traffic you could get in. So we would at times get valuation proposals that would be bifurcated between multiples for wholesale that were much higher than multiples for taproom, and today that's quite different. So fast forwarding to where we are today, the chart looks very different. You will see ABI and MillerCoors have been very much less active. I would put the CBA deal even with an asterisk, because I think that was something we all knew was eventually going to happen. It was a matter of at what price. MillerCoors has been quiet, and as we'll talk about later, focusing on Beyond Beer, going so much as to change the name of the company. Constellation did 2 small add-ons after they were dealing with Ballast Point. And then Heineken, Kirin, Lion, Mao, Sapporo did a handful of deals. New Belgium was the one announced recently, obviously, but not quite as active as they were before. Again, they still require scale, and I think many of them, like Heineken, feel they have their one horse in the market. What's encouraging is the next box. And the box below is that the craft on craft movement seems to be increasing and something we've always been advocates of, and we're tending to see more activity there. Dogfish Head in Boston, as mentioned before, being the most notable. Sierra Nevada doing their first deal with Sufferfest. And then, CBA acquiring some other smaller brewers that they had small investments in or partnerships with. So that's in a movement that we're very excited about and we hope to see continue. On the private equity side, that box is small, and 2 of those 3 were distressed transactions. So we've largely seen, with the exception of the groups already in, which are Canarchy, ABV, and now Legacy, most private equity firms have left the space. There's not yet, with the exception of LNK and Dogfish Head, a great example of a lot of private equity firms that have come in and made a lot of money out of their investments. A lot of those private equity assets are still sitting there and have not successfully been sold. So we're seeing definitely limited interest from the private equity community in the space today. Canarchy, ABV, which recently acquired the cider brand Bold Rock, and Legacy are continuing to be active, and we think will continue to do so. On the left side here, buyer rationale, this is what's changed dramatically since the peak of the market. The one area that people still want to see strong growth in your home market, they actually don't necessarily want to see you in too many states or you going across the country shipping beer inefficiently or hiring salespeople in markets that are not close to home. Now the focus is on strong margins and capacity utilization. I think the stigma of contract manufacturing is largely gone, and many of these buyers have assets with excess capacity. So they'll look at something that may be fully utilized and say, great, we can grow it and we can just, produce your brand at our facility and get some additional synergies that way versus you having a brewery sitting there that's half empty. A differentiated portfolio with strong innovation. We'll talk about it later, but innovation is driving the growth in the category. Without it, the category would be down. So doing that, but doing it thoughtfully and seeing that pipeline is really important. Brand strength and consumer loyalty. People are not just looking purely at depletions and growth in accounts, but looking at, are you driving velocity within those accounts? And then now tap rooms are becoming increasingly important. Platform, which was sold to ABI, has several tap rooms, and we're seeing that be an increasing focus versus just wholesale. We get this question a lot about valuations and where are they. A lot of data is not public, but we can tell you directionally what we know. Here's 4 deals I've highlighted here just to give you a taste of what's publicly out there. At the peak of the market, enterprise value to EBITDA, which is the most important metric, was 15 to 30 times. The peak was at Ballast Point, which, depending on which source you use, was at about 27 times EBITDA. Lagunitas not far behind at 24 times. So that was absolutely the peak of the market. Per barrel gets reported quite a bit. The reason it gets reported quite a bit is because that's information that's public. I think as the market has matured, that is becoming less and less important. Today, the market's moved pretty dramatically lower, but still, I think people have to realize in the grand picture of CPG businesses, still at a healthy multiple. So we're typically seeing 8 to 15 times. I think the Dogfish Head is a good benchmark for people to look at. That was at about 12.5 times. And there's a great brand, strong growth, high profile of scale. So if you're not growing and not as large, it's probably going to be below that. And there may be a handful of jewels that will still trade above that. As I mentioned before, this is something we're all really excited about. This is a movement that I think we've needed to see for some time, and candidly, with ABI and MillerCoors paying what they were able to pay, we hadn't seen it, which is craft on craft. These are deals that have been announced since 2018, when the market was clearly going through some challenges. So there are buyers out there They're not paying what they were a few years ago, but it's an exciting sign of some groups still out there and some activity we still expect to see. I won't read every one of these quotes for you, but I think it's encouraging to read all of them about the momentum and opportunity some of the craft brewers are seeing to continue to consolidate the category or bring in new partners. The flip side of that is what we're seeing with a lot of the strategics is just an increasing focus on innovation. And, if you're a public company, you have two ways to grow. You grow organically or inorganically through acquisition. And we're increasingly seeing them innovate. These are some of the recent beer innovations by the largest strategics. So you have AB InBev continuing to innovate with their platform brands and Goose Island. Molson Coors doing some interesting things with St. Archer. Constellation with the Corona Premier. And then Boston Beer as well. And Sierra Nevada continuing to create new platforms with Hazy Little Thing and Sierra, the Mexican lager. At the bottom of the page is a quote I mentioned before, which is really interesting, is that if you actually take out innovation, the craft category would be down 3%. And I think even more attention and focus has been going to beyond beer. Seltzers, we've all talked about it. It's staggering the amount of investment dollars going into these brands. I think it'll be interesting to see how the beer seltzer brands play out. Will there be room for craft and premium above that? It'll be interesting to see how this all plays out. But clearly, the big guys are putting tons of capital, and we don't think it's a category that's going away. And then hard craft alternatives, whether it's a cold brew coffee, a hard tea, a hard kombucha. Again, considerable investment in those categories. And non-alcohol. We're seeing the beer players come into it. They have spaces on their trucks to fill. They're already going to the same stores, so they're looking at non-alcohol alternatives. We haven't seen the non-alcohol players come into alcohol yet. There's regulatory issues they've got to get over, but we know they're looking at it. We've had recent conversations with large privately held players that are looking at seltzer. And also Pepsi Ventures has mentioned trying to evaluate the distribution network. So we think that could be coming. Nothing imminent yet, but it's an interesting time to watch how quickly the lines in beverage are blurring. But I like to come out of this optimistic and say the glass is half full. So I think we went through some of the press releases and earnings announcements of some of the larger public guys and some of our friends in the room here. And we think there's going to continue to be activity. We think we're seeing consolidation. People are watching. Whether it's Molson Coors, who's focused on above premium, which clearly this category is. Legacy, which mentioned in their presentation this morning, looking at over 100 breweries. I think Anheuser-Busch will continue to be active, but much more selective. And then Boston Beer, I think, will be interesting to watch. They have a new CEO in place. With the successful integration of Dogfish Head, that could be a real impetus for them to do more. So if you're sitting in the room saying, what if I want to sell? I probably should have said sell or raise money. What should I do? I think there's two, hats you have to wear to think about it. On the, I guess my left, is operationally what should you be doing? Kill it at home. It goes without saying, we all know that, but it's of the utmost importance is how to do well in your home market. Really focus your portfolio with thoughtful innovation. Not a beer of the week, not a copycat, not a me too, but really focused innovation. I think we've heard some really neat stories through the pitch slam and through Tommy's presentation about that. And how do you think about that from a branding perspective? Do you do a separate brand? Do you do it under your platform brand? But being thoughtful about it. And optimizing margins and utilization. The focus is now not on barrel growth, but really profitability and cash flow. And so making sure you really understand your cost structure, where you can get incremental benefits on the supply chain, where you can get more margin out of the tap room, et cetera. And then on the right side, I think you have to be more flexible. The list of buyers is shorter. And so thinking through, what may be my ideal partner, and then how do I fit? Why do they need me? Think about that and be able to answer that question. And have realistic expectations. The multiples have come down. There's no question about it. And be able to consider a structured transaction. Some of the transactions that we talked about earlier in the craft on craft page or the private equity, a lot of cash may not be changing hands up front, but you may be able to merge into a bigger partnership with more resources and smart people around the table that could be very valuable. So you have to think about that as well. And I'll just kind of end here on a quote that I love from a well-regarded restaurant executive is, think about running your business as if you will keep it forever and sell it tomorrow. That's it.
That was awesome. We've got about 5 minutes here for Q&A. Fire those questions if you have them. I'm already getting some. I've got some of my own, I'm sure. So we saw this Ballast Point deal go down. There was a lot of smoke behind that anyway, a lot of rumors about who was involved. I'd ask you to tell me what you know about the deal, but I imagine, what can you share, I guess, that maybe we don't know already?
I'll be honest, Kings and Convicts was not on our buyers list. So I don't know anything about the buyer. We knew it was on the market. That had been rumored for some time, whether it was going to be splitting up a bunch of assets. We knew Constellation wanted that off the book. So, I'm reading what all of you are reading. It's still relatively new. I think the information will continue to come in, but clearly that is not someone with deep pockets. Unless there's somebody behind it we don't know. But I think it was probably as much about assuming the liabilities as it was about, I think the purchase price was low, but they probably assumed a lot of liabilities. The fact they took all the employees was amazing, and I hope they can execute.
Yeah, so a lot of busted office pools there. Is this going to be a trend that we see where some of those breweries that were on your slide that did sell to the larger brewers are going to be coming back home, you think?
I don't think so. I think on the larger brewers, the ABI portfolio is performing very well. The MillerCoors portfolio as well. I mean, there's some, a little bit of, some ups and downs in there, but I think largely performing. Constellation's unloaded Ballast Point. And I think the international strategics, they're largely happy with what they've bought. So the ones that'll come back around are the ones owned by private equity. And some of those have tried to come around and have not had successful exits yet. So I think you'll continue to see movement with that group of brewers.
So lots of questions coming in here. Obvious question, why are we seeing so much M&A activity at the moment? Why are buyers actually buying again? And is it simply that the multiples have come down and are more realistic?
It's interesting. I still think you have to step back and put it all in perspective. There's probably been 4 announcements recently of note, and 8,000 breweries out there. So I still think it's the market's still, not like it was a couple years ago. But you're also seeing a dynamic. I think it's twofold. I think there are some buyers out there that will pay a fair price for the right asset. But I also think there are some transactions that had dynamics that, forced something to happen, whether it was an ESOP or private equity that had a put coming up in 2 years. Things like that forced a transaction that may not have otherwise happened.
Mm-hmm. Do you see any movement towards smaller local craft on craft transactions happening in the future?
I do, absolutely. I think we'll continue to see that. I think there are people that are, talking now. And, if you can get through the sort of relative value conversation, but, not everyone needs 2 sales forces, 2 CFOs, and I think people are also seeing the benefits, like if you look at Green Flash and Alpine. If you can have a couple brands in one home, and I think it's okay. I think before everyone was so against doing that, but I think that has gone away, and I think we'll see some successes of some brands doing that together.
Will deals still be done on small players as a multiple of sales versus profits?
It will be a multiple of profits.
In the world of acquisitions, where will innovations come into play to elevate these portfolios?
Well, I think innovation comes into play if you're successfully doing it and it's driving growth, because it will make you a more attractive target to people, and show that you're doing it correctly. I think craft brewers are going to need to be careful about seltzers, which a lot of people are launching, and I think we're going to have to see how that plays out, because I think there's some question about how authentic that is, and how sustainable that's going to be for some of the craft brewers if they're going to be able to compete against the big guys throwing hundreds of millions of dollars into this category.
2 ESOPs have paid out now, Full Sail and New Belgium. Is that the only positive outcome for an ESOP-structured brewery business to sell?
I'm not sure I understand the question. I mean, it's to pay off. I mean, it's really paying off the debt. The employees owned it, and then they got some return on that too. So I think the ESOP is really to put put money into the hands of all the employees, and I think the ones that can be sustainable and continue to show a profit without too much debt can be successful.
So roll-ups, if it makes sense for these folks to start buying, how can they start to assume a buying posture?
So I think, what do you in terms of a buying posture? I think the roll-ups are great vehicles for many. I think they all have to, in terms of a buying posture, I think, they're out talking and they're out acquiring brands, and they have their choice in many ways.
Is this like the dystopian Mad Max scenario where everybody's forming their own wolf packs and
Yeah.
out for survival?
Right. No, I think it's true, and I think I do think these groups like ABV, Legacy, Canarchy, with scale, there's a lot of benefit that comes with that, even just from the purchasing and logistics side, and brewing side. So I think there's a lot of benefit to those platforms, and those guys are gonna have the pick of some really nice brands.
Well, thank you for everything here. Thank you guys for the questions.
Thank
Appreciate
you.
it.